Thank you for having me. Thanks for being here. I'm truly honored to speak to you guys. This is my first FI event. So you guys are clearly very proactive when it comes to your finances because you guys are all here. And I have a very simple mission, but it's pretty huge. And so I'll talk about that next. So I'm Atiya. I'm a CPA licensed in Canada and in the US. I am originally from Montreal, Canada, but I've been in the US for about 15 years. I have 2 kids and I have a husband. And I want to support women in business, help them with their taxes. I have a big goal of saving my community $1 billion in tax savings. And so I want to use what I understand, which is taxes, and help them build wealth that way. So I saved my clients over $4 million last year, and we have a goal of doubling that this year. Here's just some of the places that I've been featured. So today we're going to talk about retirement accounts. We're going to talk a little bit about real estate, and we're going to talk about a few tax strategies that small business owners should be aware of. And because you guys are in the FI community, small business gigs might be something that you guys are going to consider. There are a lot of different retirement accounts, so I just wanted to talk about some of them and kind of touch base on the differences between them. So the first one is going to be a Roth IRA. The contribution limits, it's going to be $6,000 per year, $7,000 if you're over the age of 50, and the income limits are going to be important for you guys to understand. So 129 to 144 if you're single or if you're head of household. If you're married filing joint, it's going to be the 204 to 214, and you want to make sure that you aren't over contributing. So one of the strategies that I'll talk about on another slide is the timing. You might want to consider contributing when you're actually filing your taxes to make sure that you're not going over your AGI. So that's something that you guys want to keep in mind. The tax benefits of the Roth is going to be tax-free growth. And when you withdraw it, it's going to be tax-free because you guys are contributing with taxed dollars. Next, we're going to talk about the traditional IRA and the SEP IRA. So you're going to have the same limits, but for the SEP IRA, for those that are self-employed, you actually have the benefit of contributing up to 25% of your net income, up to $61,000 in 2022. And there are some income limits that you need to be aware of, $66,000 to $78,000 for single or head of household, and then married, you have $109,000 to $129,000. And the tax benefits or implications here are you get a deduction for the contributions. When it's in the account, it's going to be growing tax deferred, and then when you withdraw, you're going to have to pay taxes at that time. Then you have your employer-sponsored accounts, so that's going to be your 401ks, your 403bs, depending on the type of industry that you work in, nonprofit or profit. And that is going to be, as the employee, you're going to be able to contribute the $20,500, the $27,000 if you guys are over a certain age. And on the employer side, that they're going to be able to contribute up to hitting the max for you of the $61,000. So I hope you guys see that that $61,000 is pretty much the same under the traditional and the 401k. It just depends on who's going to actually be contributing. So when you are the employer and the employee for self-employed under the SEP, you can contribute that total 61, whereas if it's an employer-sponsored plan, your limit is the 20.5, and then the employer can contribute up to the 61. So that's where the employer matches come in. There are some income limits for that. It's going to be $305,000, and again, similar to the traditional and the SEP IRA, you get a tax deduction with the contributions, and then it's going to grow tax deferred, and then you're going to pay taxes when you are withdrawing. And the HSA, an account that I like to talk about with my clients that are healthy and young, because the tax benefits are trifold. Your contributions are going to be tax benefit, it's going to grow tax-free, and when you withdraw it and use it for medical-related expenses in your golden years, then that's going to be tax-free as well. So the HSA is a really great benefit that this community can benefit from, so I like to mention it when we're talking about retirement accounts. So some things that you guys should consider is which account to open. And that's going to depend on your tax bracket. So I hope all of you are aware of the tax bracket from 10 to 37% where ordinary income is taxed. So that's going to be something that you want to consider in your strategy for which accounts you want to open. So obviously the Roth, because it's pre-tax dollars, it's tax dollars now, and it's going to be tax-free later on. If you're in a tax bracket that's going to be more beneficial for you to contribute to that, you want to consider maxing those out. Whereas if you're going to be in a lower tax bracket in your golden years, then the traditionals are better because you'll be taxed when you withdraw it. And if you're in a lower tax bracket, that's going to be something that you want to consider. When to contribute, so I did mention that before, because the Roth has those limits, you want to make sure you don't go over those, filing, like contributing when you actually file your tax return, when you know your actual AGI, that's going to be a good time to contribute because the deadline is going to be in April of the following tax year. So you have time to contribute. You want to make sure you do that because over contributing can have a penalty of 6%. And you want to make sure that you're aware of some early withdrawal penalties because you guys are in this community. Some of you might be tapping into these retirement accounts sooner than later. So you want to make sure that you understand the penalties of early withdrawal and keeping that in mind. Tax brackets are going to matter. So what we just talked about is understanding if you're in a higher tax bracket now versus later on. That's going to dictate which accounts you want to maximize. The timing of when you're filing your tax returns, that's going to be a good time for you to contribute to your Roth so that you make sure you don't over contribute. The magical age of 59 and a half. So there are some exceptions where you can withdraw before you hit that age. So here are just some exceptions. The IRS.gov is a great website where I would recommend that you guys get familiar with it because it's going to give you a lot of resource information. All right, so let's talk about real estate. So real estate is like near and dear to my heart. Most of my clients are in the real estate industry. So I'm just going to touch high level because we do have a speaker tomorrow that's going to talk about real estate. But a capital asset, what is it? So it's basically an investment that you're holding for personal purposes, but you are expecting that it's going to appreciate, right? So that's the purpose of you holding these assets. So it can be real estate, it can be stocks, bonds, it could even be stamp collections. So these are just some examples of what capital assets are. And the reason I gave that definition is because capital gains comes up a lot when it comes to taxes and real estate. And so what are capital gains? When you sell this asset that we just talked about, if you sell it for more than you purchased it, then you're going to have a gain. And so your selling price is going to be more than your basis, and you're going to have a capital gain, and you have to pay taxes on those capital gains. And so the way those capital gains are taxed is going to depend on a few factors. So first, it's going to depend on what was the purpose of you holding this asset. Were you an investor or were you a trader? So an investor is someone who's holding it and they're holding it for the long term. So in the terms of real estate, if you are holding it to, rent it, so you're buying and holding it, versus a trader. If you are a flipper and you're constantly flipping, you're buying inventory so that you can flip it, you're going to be considered a trader for tax purposes, and the real estate that you actually purchase is going to be considered inventory. So for the investor side, your capital gains for the most part are going to be passive. For the trader side, your capital gains are going to be active, and it's going to be considered active income. So it's going to be treated like ordinary income when you are a flipper. When it comes to capital gains, short-term versus long-term is going to come up. And so short-term is if you're going to be holding it for less than a year. Long-term is going to be holding it for longer than a year. And so this is another way to look at the investor and trader. Typically, if you're holding it for a long time, you're going to be the long-term, and the flippers are going to be the short-term. And that's why the short-term is taxed as ordinary income, whereas the long-term, you're going to have more preferential treatment when it comes to the taxes on your capital gains. So when it comes to capital gains, a lot of people want to know, how can I not pay it? But sometimes that's not a question. So we talk about deferring capital gains, like the payments that you have to pay on the taxes for these capital gains. There are a few ways that you can defer it. So a 1031 exchange is when you have a property and then you sell it, but you want to designate a separate property to replace it. And so the government created this 1031 exchange where you can exchange real property. And so they allow you to defer the taxes that you're going to pay on the capital gains and any recapture. You're going to roll that into the next property, and you're able to do this as long as you keep rolling properties. 1031s can be very complicated. There are 180 days that you need to make sure that you are aware of. The first 45 days are going to be very important. You need to find a replacement property. You need to make sure you follow those timelines. Make sure you're working with an intermediary that's going to help you make sure you stick to all these timelines. Otherwise, if you miss the deadlines, then you're going to have to pay taxes on those capital gains and that recapture. So you want to make sure that you're doing the 1031 exchange correctly. Installment sales are another way for you to defer the taxes on capital gains, because essentially what it is, it's you selling the capital asset in different installments. And so you're only going to pay taxes on the installment piece that you're in that time. So that's another way for you kind of to split the taxes that you're going to pay on the capital gains. The next one is an opportunity zone. Opportunity zones were designated across America. You guys can Google the areas that they designated. They wanted to revitalize certain areas, so they're giving tax incentives for you to invest in those areas. A couple of caveats when it comes to opportunity zones is you have to be using capital gains. So you have to have had stocks that you sold that you generated a capital gain. You can't just get the tax benefits by just taking cash and going to the opportunity zones. But some things that you can consider tax strategy wise are if these opportunity zones are going to be blowing up because they're directing people to invest there. If you can do investments in that area, even if you don't have capital gains that are going to give you the tax benefits, your property is probably still going to appreciate because of everything that's happening there. So while opportunity zones have to be funded with capital gains, I don't want you to think that if you don't have capital gains, that you can't benefit from everything happening in those opportunity zone areas. There are still benefits there. So those are some ways that you can defer your taxes on capital gains when it comes to real estate. Let's talk about tax strategy versus tax prep. This is a question that I get a lot. So I like to do the analogy of a puzzle versus a painting. Tax prep is really a puzzle. The picture is already set up, it's just cut into different pieces. So the compliance piece of tax preparation is really taking the puzzle and putting it together. But everything is already set. You're not setting anything up, you're just putting it in the right package, making sure the correct return is filed, making sure it's filed timely, making sure there are no errors, and that's what tax prep is. It's a very important thing, but it's really compliance. Whereas tax strategy is taking a blank canvas. So if you're a creative, it's taking a blank canvas and knowing the picture that you want it to be. So you want to save taxes in the future. So you're going to be meeting with your tax professional throughout the year. They're going to be knowing the goals that you want to do. They're going to understand the tax code so that they can say, hey, you want to do this? Let's do it this way. This is going to save you on taxes this way. So you're going to meet with them several times throughout the year so that we can help paint the picture of how you actually want it to be. And so tax strategy is going to happen multiple times throughout the year, and it's going to have a different price point because we're actually setting up the picture that you want to see, whereas with tax prep, whatever happened from January to December is pretty much what's going onto the picture. There's not much strategy that can happen at that point besides some of those contributions that we talked about earlier, but there's not much tax planning that can happen when you go to your tax professional in that February, March, because the April deadline is coming around the corner. So this is where I talk about when you are starting a small business. A lot of times I know social media has a lot of gurus on it and they tell everybody you need to get an LLC. Well, I like to tell people that there are different entity structures that have different tax implications, and so your LLC might not be cutting it for what you need it to do. And so you need to understand that the LLC is not the only entity structure, and as a tax strategy, that's going to help you with your tax bill. Because one of the things I tell people is that there's no one solution for everybody. And an LLC might be good for you, but an S Corp might be good for you, or a C Corp might be good for you. Or depending on what you're doing, your sole proprietor might be well. A sole proprietor is a legitimate tax entity. You're going to get tax benefits the same way you would if you actually had a single member LLC. But a lot of times people don't realize that. They tend to think if they're a sole proprietor, they're not a business. I'm here to tell you that you are. So if you are making over $400 doing anything on the side, you are considered self-employed and you are required to file a Schedule C on your personal tax return. And so knowing your entity structure and understanding the tax implications such as self-employment tax, such as do you have to pay yourself on a salary or are you paying yourself with withdrawals? Because you need to understand the different tax implications. A salary is going to have payroll taxes associated with it. Withdrawals aren't going to do anything to your profit and loss because every single thing that your business makes, if you are paying yourself on withdrawals because you are a single member LLC, it doesn't matter what you take out of withdrawals, everything that the business makes is going to be taxable on your Schedule C. So your entity structure is a tax strategy that I think everybody needs to start with. So when you have a small business, you need to make sure you're in the right entity structure. And the entity structure you're in, it is not set in stone. You can change it. There are ways to change it. There are forms to change it. So sometimes you need to make sure you're talking to your tax professional to see if it's time to change your entity structure. So that's something that you guys want to make sure that you're aware of when it comes to setting up the entity side of your small business. There's a hiring strategy that a lot of you might be ignoring. You can hire your children. If they are helping you in your business, they can actually be a tax benefit. A lot of times, I don't know if you guys are on social media and you hear a lot of the gurus saying, hire your children for $12,000 and it's tax-free. There's some truth to it and there's some that's just, you cannot hire your children to do chores. It has to be a legitimate job that's in the business. It has to make sense for their age, and they have to be able to do it. So it has to be something documented, and you have to be paying them into their own account. And that 12,000 number, it's not a magical number. It's actually represents the standard deduction. And so this year it's 12,950. So if you have a 10-year-old who's really good at setting up technology, and they could have helped us here today, they could have been paid for that. And so they could have been paid for that because that would have been their job, right? And so you would be paying them into their direct account. And because you guys are in this community, I know what you guys know what that means. So if they now have earned income, think about the accounts that you can open for them, that they can be saving. And now if they're starting at 7 years old, saving in these Roth accounts, what is that going to look like when they become an adult? If you have a 16-year-old, maybe their job merits them to be paid $20,000 a year because of what they're doing for you. And that doesn't mean that you can't hire your children that are over 18. Another strategy we talk to our real estate clients is if you have out-of-state properties and they go to college out there, they could be the property manager for that property. And now you just created a business for your child. So now they get all of these deduction and benefits that we were talking about for you. You get to pass it on to them because now they can be paid through the business to be your property manager. So there are so many things that you can do, including your family, into your tax planning. The next strategy that I like to talk about is a simple write-off that every business owner has. And when I say every business owner, as long as you have a house, you have this tax deduction. And a lot of people aren't using where they lay their head as a tax benefit that's going to benefit them. So this could be twofold. So home office deduction, a lot of times people think that that's like a red flag when it comes to getting audited. How many people think that? I've definitely heard of that. Yeah, it's not. So as long as you have a business and it's a legitimate business and you're working from your home, if you have a designated space in your home that is used just for business. So unfortunately, it cannot be your dining room table because you do eat there and everybody eats there. But it doesn't have to be a full room. It could be a walk-in closet that you have a space designated just for your business. If you have your desk set up there and that's all you use, you can take that square foot percentage divided by the total square foot of your home, and then you can now write off your personal use expenses, such as cable, internet, all of those things that you are paying for to run your home. You are using those expenses to actually run your business as well. So it's not a red flag as long as you guys keep the records that you need. I like to tell people all the time that audits don't have to be scary. I used to be an auditor for 8 years, and audits aren't scary. It's really just the government's way of dotting their I's, crossing their T's, making sure. Because back in the day, when you filed your return, you would have to send all of these documents in with it. Now everything is electronic. So really, they're just getting all these forms of people saying things, and they're like, well, we do need to check that everything that people are saying. Audits really happen less than 1%, so it's really not happening that often, and when they do, they are figure-outable. When it comes to taxes, you can be stressed about stuff, but as long as you're working with a professional, everything is figure-outable. So even if they do come back and want to see the proof of something, as long as you have it, you have nothing to worry about. The second thing about people ignoring something when it comes to their home is the government created a tax code called 280A. So if you guys want to look that up at any point, you can. And what it says, it's called the Augusta rule, because there's a big golf tournament that happens in a famous city, and there's wealthy people on the golf course, and they wanted to figure out how can we get benefit, like a tax benefit of this time. And so it was created, and this is called the Augusta rule, because you're able to rent your home out for up to 14 days, and you can get that benefit and not have to report the income from renting that out, because under 14 days, it's not considered that you are doing this for rental income. So this is basically additional income that you can earn and not have to report that rental income because it's under the threshold. And that came about because of this Augusta golf tournament, where people were coming into the state and they were, people wanted to figure out, how can I profit off of all these people coming into my home state, and so that rule was created. So how does this work as a strategy for small business owners? Well, if you are going to rent your home for your annual meetings, for your monthly team meetings, those are going to be things where you can actually write that deduction off for the business, and you don't have to report the income. Because typically, I hope you guys understand that income for one is usually an expense for another, right? So it's usually a full circle. If it's an expense over here, it's going to be an income for somebody else. But in this case, the income doesn't have to be reported. So there's not going to be taxes paid on the income, but you still get the benefit of the tax deduction. The way that you can figure out the Augusta rule is you would find like a conference room in your area, find what the market rent is for you to rent that space, and then you would have that space for 12 months, because if you have the monthly team meeting every month, you can have that, and then your annual meeting, depending on how your entity is set up. But that could be, you know, a potential $12,000 deduction, depending on where you guys live, where you can have these meetings and get that deduction. So that's a tax benefit from writing off your home. And after this is Q&A.